Hey guys, it's Hamish here and welcome back to Stock Market Q&A. It's Q&A time for February 2019. Thanks to everyone who commented on my post in the community board and left questions there, and also people who commented on last week's video, last month's video, January 2019. So all of those comments have been brought together, or a few of those comments have been brought together and placed into this video so that I can share with you my thoughts on some of your specific questions. So of course, if you have any questions for the next month's version of this video, then make sure you leave them below this video. And again, as always, I'm going to be making a post on the community board just before I make that video, as I did with this video. So if you miss your chance to leave a question below the comment section here, then make sure you comment on that. But of course, if you do enjoy this, make sure you leave a like and let me know that you want to see more of these into the future. These seem to be fairly popular, so I think I'm going to continue to do them. You guys seem to be liking them. But for now, guys, let's get straight into it. Oh, by the way, guys, I'm going to be taking my mugs off my Etsy store, which is where you can get access to these if you want to support the channel for a little bit. So if you are interested in getting your hands on one of these awesome mugs that I designed myself, then make sure you go over to Etsy. The link is down in the description below and purchase it, because I will be taking that off in the next couple of weeks. All right, so the first question we've got for today is from the Millennial Investor, and he asks, at what point do you cut a losing trade? How far must it stray from your original fundamental analysis? All right, so there's basically two reasons why a stock will be falling. The first reason is that the long-term value of that company has fundamentally changed to the downside. And for that reason, a lot of investors and fund managers and all those kinds of people in the market are selling the stock and sending it down. So that's one reason. The second reason could be that it's facing a short-term headwind. So something is happening in the short term that's affecting the profitability of that company for the next 12 to 24 months. However, the long-term value of that company, the 10-year profitability of that company, is unchanged. They're the two circumstances in which a company's stock would be falling. Now, in my personal opinion, I think that the only reason you should sell a stock from one of these two circumstances is if the long-term value of that company is also falling. If the short-term value is falling but the long-term is fine, then I think you should hold on to that, because it means that, because that's always usually the case, there's something that happens in the short term, it sends the stock down. But if the long-term value of that company is still there, then it's going to return back up to its long-term value. And by long-term value, I just mean how much cash a business can provide you. So just recalculate how much cash that business can provide you over the next 10 years. And if that number, discounted at a risk-free rate, which I have a video on how you can calculate the value like Warren Buffett using a discounted cash flow. So if you want to learn what I'm talking about here, or how to do that, then I'll leave a card to it up there and a link to it down in the description below. But essentially, you just want to recalculate that value and make sure that that number is above the current stock price. If that number has fallen below the current stock price, then you want to sell it. It means that it's overvalued. It means that the price you're paying is higher than the amount of cash that that business can provide for you. Now, the other problem here could be that you don't know how to calculate how much cash business is going to provide for you. And if that's the case, then you definitely want to sell it. You only want to be invested in individual businesses where you can calculate exactly, or not exactly, but you can be confident in how much cash that business can provide for you conservatively, or within some sort of range over the next 10 years. And if you can't do that, then maybe that's not a good investment for you. All right, so then I had a couple of people who were asking me about the big four banks. What did I think about the banks, and what do I think about their valuations? Are they a buy? Are they a sell? And the first point to make here is that banks and financial institutions are definitely outside my circle of competence. So these businesses are very complex. They have a lot of moving parts, and unless you've been working in the industry for quite a while, I think it's very difficult to thoroughly understand how these businesses operate and what drives their profitability, and how to calculate how much cash they can provide for you. So for that reason, I've never really attempted at all to calculate the value of a business, let alone the big four businesses. So I can't really say much or give a valid opinion to the value of those businesses. And I suggest that you should only invest in the big four banks if you thoroughly understand how they operate. Don't just invest in them because they offer a high dividend and you think that bank stocks are safe, because we know what happened in the US to a lot of their banks. Some of them went bankrupt. A lot of them lost a lot of their value. And we wouldn't want to see that happen to you. And that wouldn't happen to you if you thoroughly understood those banks and you were in the US. So just stick to businesses that you thoroughly understand. And if you don't want to put in that effort in order to work out how these businesses operate and calculate their future cash flows, then just invest in the whole market and completely diversify yourself and just accept the market return. Although in saying that, National Australia Bank was one of the first investments I ever made. I think it was either the first or the second investment that I ever made. But of course, if I was to go and do that all over again, I wouldn't have made that investment because it is outside my circle of competence. And when I bought it, I did not do any sort of calculations as to how much cash National Australia Bank could provide me over the next 10 years. The only reason I'm really holding on to that is because I'm just waiting for another opportunity to pull that money out and put it into another business. I have a couple of opportunities lined up and they're very close, so it's only going to be a matter of time before I take that money out of NAB and either just sit it in cash and just wait for some future opportunities which are likely to come because we're in the late part of this cycle, or I'll pull it out and directly put it into another investment which is going to offer me a better return. And at least it's going to offer me a return that I'm confident in, because I have no idea what return I'm going to get out of National Australia Bank. It could be positive, it could be negative, it could be zero. Whereas I have other investment opportunities where I'm pretty confident in how much cash they can provide me over the next 10 years. So for that reason, I'm going to be moving that money out of NAB and into those other investments. All right, so the next question we have here is from Nicola, and they ask, what do you think of the 2020 recession talk? So do I think that there's going to be a recession in 2020, or what do I even think about people saying this? So especially in the last couple of weeks, this has been crazy. There is a lot of people in the finance and business space that have basically just come out, written articles or written statements saying, we're gonna have a recession at the end of this year or in 2020. And that's scared a lot of people, I think. And a lot of people are wondering, well, if all of these great business people are saying it, then it must have some sort of validity. It must have something behind it. However, the one thing that I've learned when investing is that just because a lot of smart people say something doesn't make that thing smart or true. Just because a lot of people are saying something, it certainly does not make it true. Ultimately, nobody knows when we're going to have a recession. People can make estimations based on the projections of data that we have, like growth is going to slow down here, this is going to happen here. But ultimately, we're still speculating about what's going to happen in the future for the entire US or Australian or even the world economy. And ultimately, we don't know what's going to happen. We don't know, maybe in 6 months' time, consumer spending just goes up massively and businesses start to become massively more productive, and then growth increases. And then all of a sudden, everyone's saying, wait, we've still got 2 or 3 more years before we're going to have a recession. In fact, people have been saying that we're going to have a recession since the last recession. Go back and have a look at some articles from 2013, 14, 15, even before that, or just in the last couple of years. There has been people saying this for so long, and there's been a lot of really, really smart people who have been sitting in 100% cash for 5 or 6 years and have missed out on massive stock market gains that might not even be erased in the next recession. Nobody knows when it's going to be. No one knows how devastating it's going to be. No one knows how it's going to affect the market. Maybe it doesn't affect the market that much in terms of a capital loss. Maybe it's 20, 30%. Maybe it's 60, 70%. Maybe it happens in 5 years or 1 year. No one really knows. And just because a lot of people are saying something about it doesn't mean that you should sort of change your investing strategy based on what they're saying. And they might be completely right. We might go into a recession in 2020. A lot of people are saying it. And I wouldn't be surprised, because we are in the late part of the cycle. So I would personally expect that we would have a recession in the next 5 years. Like, I would be confident in saying in the next 5 years. I wouldn't be confident in saying the next 1 to 2 years, because I just don't think that you can get that specific. Maybe it'll happen, maybe not. But ultimately what it comes down to is your investing strategy, and you should not change it based on the fears of a recession. Your investing strategy should basically be to invest in severely undervalued investments that are guaranteed to make you a return, and to sell those investments when their price exceeds their value. And through this process, you will naturally move in and out of stocks and cash through the natural progression of an economic cycle. So towards the end of the cycle, a lot of stocks are running up really massively because the companies have been really profitable over the last 10 years, and everyone likes how these companies have performed because they've been going up and up and up and up, and therefore people are piling money into these stocks. And that's what we've seen especially in the last couple of years. Stocks have been going up massively. And what this has done is it's pushed a lot of stocks in terms of their price above their value. And through this process, myself personally and a lot of other investors have been starting to move out of stocks and into cash. And I started this process at the start of 2018. So around that time, I reevaluated some of my investments in Google, Adobe. There's a couple other in there. I can't think of them right now, but I reevaluated them and I realized that they were massively overvalued. So I sold them. And luckily that was just prior to those two massive corrections that we experienced in the end of February, I think it was, or the start of February. And since then, the US market has been down. So I started to move out. I'm now in about 50% cash or maybe 60% cash. I'm not actually sure. I'd have to calculate it. But then if the stock market crashed, I'm not waiting for it or anything. I'm just looking for opportunities and I can't find anything. So since I can't find any opportunities, I'm just sitting in cash. And if the market crashes, there will be more opportunities and I'll deploy some of that cash. And then I'll be 80% in stocks and 20% in cash. And we can start the whole process over again. So don't worry about a recession. Just manage your portfolio based on whether or not you think the stocks in your portfolio are undervalued or overvalued. If they're undervalued, hold them or buy more. And if they're overvalued, you should be selling them. All right, so the next question we've got here says that I'm looking into electronic arts and Roku. What are your opinion on them in the next 2 years, assuming that there is no recession? Would you please check if they are undervalued at the current price? All right, so there's two things here. The first thing is that I've never really looked in depth into these companies, so I can't give you a valid opinion on whether or not they're undervalued or whether or not they're even great companies, because remember, they might look undervalued, but we need to know that they are great companies that are going to sustain themselves over the next 10 years. And the second thing is that I never look 2 years out. I always look at least 5 to 10 years, if not more. And the simple reason for that is that the vast majority of people investing in the market, that's Wall Street, that's retail investors, and that's fund managers managing massive amounts of money, they're all looking in the next 2 years. They're all looking to make money now. And for retail investors, that's because often they're misled to think that they need to make a profit instantly in the next 1 to 2 years. For fund managers, it's because they're assessed on their performance for the next 12 months, if not quarterly. So they're always focused in the short term. But all of these people are focused on the short term. And all of these people have a lot of money, a lot of resources. I mean, Wall Street and fund managers are piling millions, if not billions of dollars into studying these businesses in the next 2 years. And for that reason, I think that it's very difficult to outperform the market if you just look in the next 2 years. Because if there is a mispricing in the market, Wall Street or fund managers will quickly find it because they're concentrating resources looking there, and they will exploit it, and therefore the return, the abnormal return that you could achieve, the market beating return that you could achieve by investing in that stock won't be there for very long, and it's very hard to find those opportunities. And based on this and based on my research and what I've been doing for the past couple of years, what I've really found, in my opinion at least, is that it's almost impossible to make a high return in those 2 years. But if you look 10 years out, if you look at the whole 10 years, and you only invest in really stable companies where you can predict 10 years, because that's another thing. Some companies you can't predict what they're going to do in the next 10 years because they're too unpredictable. But if you can predict that company and you look 10 years out, often what you'll find is if there's a bit of short-term negativity, something that is going to hurt the profitability of a company in the next 2 years, Wall Street, retail investors, and fund managers will sell it. And that means the stock price comes down. And that's justified if you want to make money in the next 2 years. So that stock is coming down because it's not going to perform well in the next 2 years. However, if you don't just include the 2 years of profitability, if you include all 10, then maybe that back 8 years of profitability are really, really strong. And because Wall Street isn't considering them, it actually makes the stock undervalued at the current price. And that's what I try to do. I try to exploit those opportunities where a stock is getting beaten down in the short term, like Thor Industries, when everyone's worried about a recession and the fact that we're probably going to have a recession in the next couple of years. Everyone's worried about that. In terms of fund managers, Wall Street, and most retail investors, they're all selling it. But me personally, I look at it and I think, yeah, they'll have 2 years of pretty low profitability, maybe if we have a recession, maybe not. But then look at the back 8 years. The back 8 years look awesome. They're going to perform more or less as they have in the past because their strategy has been so consistently good. And if I include all of those cash flows, then I can have a look at their valuation and see it looks a little bit more attractive than what Wall Street and what fund managers are saying. So I would suggest, personally, just my opinion, of course, but I would suggest that you're better off looking further out and only investing in really stable companies. Companies that have been doing the exact same thing over and over and over and over again for 20 or 30 years and have shown a consistent growth in their cash flows and in their equity. All right, so we've got one more question for today here, and I won't read out the whole question, but I did read it, and I'm really glad that the spreadsheet is helping you sort of invest like Phil Town and Warren Buffett and that sort of thing. So I'm really glad that the spreadsheet is helping you. But his question here is that, what is it? I have, how is your buying strategy for Thor Industries for the next 5 years? Do you plan to make rebuys every quarter or every half year? I originally wanted to buy shares of Heimer, that's Erwin Heimer, for the last summer because I think they're a great company. I now plan on buying Thor in the next 2 to 3 weeks. My target is to hold them for at least 10 years, the same as you, and to purchase them consistently as long as they are undervalued. All right, so as for Thor Industries, I generally just have a range at which I think that if I could get my average price into that range, then I'm pretty much guaranteed to make a return that I'm happy with. So I've calculated how much cash Thor can return to me conservatively. That's the value of it. And I want to pay a lot less than that so that even if they don't bring in as much cash as I expect conservatively, I'll still make a decent return. So that's essentially my strategy. I'm always looking for opportunities where I can bring down the average price that I've paid for Thor Industries and get it into that range, because my average price at the moment is a little bit above that range. So I do want to bring it down into that range, and not only bring it into that range, but get it as close to the bottom end of that range as I possibly can. But in saying that, I do also have to balance a couple of other things with that. The first is that I don't want it to be too much of a massive position in my portfolio because of this Erwin Heimer acquisition. So when they acquired Erwin Heimer, they took on about $3 billion in debt. And this is the most debt that this company has ever taken on in their history. And for me personally, I'm very, very risk averse to debt. I don't like it at all. I don't want to see it, especially when we're in the late part of the cycle, because companies that load up on debt right before a recession hits, and then their profitability drops and they can't make the interest payments. And I don't want to see that happen to Thor. Now, I'm not as worried as I would be if I was in other companies, because Thor has a great track record of managing their debt. However, that is with different CEOs. This is a new CEO that's come around in 2013. So there is some concerns there. And for that reason, I don't want it to be too much of a massive position in my portfolio. At the moment, I think it's about 20%. And I'd like to keep it around 20 to 25%. I definitely don't want it to be bigger than that. And the other thing is that I've also got to consider other investment opportunities. So there are other great businesses that I've found out there, but their prices just aren't quite there. So I will also be waiting, and I want to hold a significant amount of cash for when those prices come down, which they most certainly will at some point in the future. When those prices come down, I also want to be able to exploit those opportunities. I don't want to just be all in on Thor Industries and have no money to shuffle around into other businesses. I want to have plenty of free cash so that I can invest it in those opportunities. So to answer your question, no, I'm not really investing in Thor at regular intervals, but I essentially ask myself 3 questions every time I want to invest in Thor. Is it undervalued? At my recalculation, go through the calculations again. Is it undervalued? Is it less than 25% of my portfolio? If it's above that, then I can't add to it. I might even have to sell some. And the third question is, are there better investment opportunities out there? then Thor. So if Thor's offering conservatively an 8 to 10% return, then and another business is conservatively offering me 15 to 17%, then I'll want to go to that opportunity instead of Thor. So I hope this video helped to clear up some of your questions. Again, if you do have any questions for next month's video, make sure you leave them down in the comment section below, and make sure you smash a like to let me know that you enjoy these videos. But I hope you guys have a great day, and I'll see you in the next one.